Welcome to the Explainer. Today, we're going to do something really cool. We're going to take what looks like pure chaos, a trading chart, and decode it. We're going to learn to read its secret language and really see the stories it's trying to tell us about what's happening in the financial markets.
Okay, so here's our game plan. First, we're going to tackle why any of this even matters. Then we'll get into the basic vocabulary, learn the lingo. After that, we'll figure out the grammar of the market. And finally, the fun part. We'll start spotting those key patterns that traders are always looking for.
All right, let's dive right in. First things first. Have you ever stared at a trading chart and just felt completely overwhelmed? Yeah, you are not alone. We're going to tackle that feeling head-on.
So, does this look familiar? I bet it does. For most people, to the untrained eye, this is just a jumble of chaotic lines. It feels totally random, right? Like there's no rhyme or reason to it whatsoever. But what if there is?
See, here's the thing. This is not random noise. The whole idea behind what's called technical analysis, well, it boils down to one super simple idea, and it's right here on the slide. History repeats itself. The patterns from the past, they leave clues about what might happen in the future. Our only job is to learn how to spot them. So, okay, how do we even begin to read this new language? Well, it's just like learning anything new, really. You gotta put on the training wheels first. We need to build a really solid foundation, and that means starting with the absolute basics.
So first, we're going to start with a super simple line chart. Just think of it like the basic outline of the story. It shows you the general path. Then, we graduate to the candlestick chart. Now this is where the real detail is. Every single one of those little candles tells a rich story about the fight between buyers and sellers during a specific chunk of time. And the source material has this brilliant analogy for it. The line chart, it's just like training wheels on a bike, right? It helps you get your balance, understand the general direction, before you're ready to take them off and ride for real.
Okay, next up is a really important concept, time frames. And I love this analogy. Think of it as your own personal magnifying glass. You can look at a daily chart to see the big picture, right? Or you can zoom way in to like a 5-minute chart and see the action up close and personal. It's the exact same story, you're just looking at it from different levels of detail.
Okay, so we've got the basic vocabulary down. Now it's time to learn the grammar. Because the market doesn't just move randomly, it actually has a pretty predictable structure. It moves in what we call trends.
You'll notice the market never goes up or down in a perfectly straight line. It kind of zigzags, right? It creates this series of peaks and valleys, and our source calls them elbows, which I think is a great way to put it. These sharp turns, these elbows, are the building blocks of the whole market structure.
So first, let's talk about a bullish trend. That's just a fancy word for an uptrend. And there's a simple recipe for it. The price makes a high, then it pulls back a bit, but to a higher low than before. Then it pushes up again to make a brand new higher high. As long as that pattern, higher highs and higher lows, keeps happening, you're in an uptrend.
And on the flip side, you've got the bearish trend, or a downtrend. It's the exact same logic, just, upside down. The price makes a low, it rallies back up but to a lower high, and then it falls again to make a new lower low. That's the textbook definition of a market that's heading down.
And this right here, this is the key takeaway, straight from the source. And you've got to understand, this isn't just a suggestion. It's like a fundamental law of market physics. It is absolutely impossible to have an uptrend without those higher highs and higher lows, period. It really is that simple, and it's that important to get.
Okay, so remember those elbows we were just talking about? Those peaks and valleys? Well, it turns out they're not just random turning points. They actually leave behind these powerful memories in the market, these levels that the price will often react to again and again in the future.
And our source explains this perfectly. Think of support as a floor. It's something the price can bounce off of, something that holds it up. And resistance, well, that's like a ceiling that stops the price from going higher, pushing it back down.
So right here, we can see these levels in action. See how the price bounces off that floor of support, and then it gets smacked down by the ceiling of resistance? But here's where things get really, really interesting. What do you think happens when the price finally breaks through that ceiling?
It flips. The roles totally reverse. That old ceiling, it becomes the new floor. This is such a critical concept to understand because it shows us that the market has a memory. What used to be a barrier now becomes a launch pad.
All right, let's take a quick breather. We've got all our building blocks now, right?
We understand trends, structure, support, and resistance. So now we get to the really fun part, using all of that to spot repeating patterns. It's kind of like finding Waldo in all that chaos.
So, one of the most powerful signals you can look for is called an engulfing candle. This is when a single candle is so huge that it completely eats or swallows the one right before it. When you see this, it's a massive signal that either the buyers or the sellers have just taken complete, decisive control.
The source has a great way of thinking about this. It's like a car race. Imagine if you were allowed to place your bet after one of the cars had already lapped everybody else. That's kind of the power of an engulfing candle. The market is literally showing you its hand.
And hey, it's not just about these single candles. When you start combining them, they form these bigger patterns. And again, the source uses the perfect analogy. It's like, where's Waldo? You know how at first it's impossible to see him, but as soon as you find him, you can't unsee him. It's the same with these patterns. They just start jumping out at you.
So one of the most famous of all these patterns is the head and shoulders. And we've got it laid out right here. You see that first peak? That's the left shoulder. Then there's one final big push higher, that's the head. And then a weaker attempt, that's the right shoulder. What this is telling you is that the buyers are getting exhausted. But the real signal, the confirmation, is when the price breaks that neckline, that support level. That's when you know the trend might be reversing.
But listen, here's a really crucial piece of real-world advice from the source. And this is so important. Charts are not textbooks. These patterns are often messy. Sometimes they're downright ugly. So don't go looking for perfection. You have to look for the underlying story that the structure is telling you. That's what really matters.
So there you have it. We did it. We've gone from staring at what looks like total chaos to actually understanding a language with its own grammar, its own structure, and repeating stories. You know, the biggest takeaway here should be this. Charts aren't just random squiggly lines. They're a visual map of human psychology. It's all right there. The fear, the greed. And now you have the decoder ring. So the only question left is, what patterns are you going to see?